of Elsie Chen from Goldman Sachs. Your line is open.
Good morning, Jidong, Greg, US, and James. Congratulations on the solid quarter again, and thank you for taking my questions. I have two questions here. First is on the RCF take rate. Understand that we're targeting to serve higher quality client cohort with lower interest rates amid this environment. However, given the recent clarification on the applicability of 4 times LPR restriction, just wondering, can we expect some upside in RCF take rate for us now that we probably have more flexibility in interest rates as well as targeted client cohort? And my second question is really on the guidance. If my calculations are correct, our new loan sales in first half 2021 is guided to grow at a very solid pace of 21% year-on-year at the midpoint. So can management share a little bit more color on the major drivers of the growth? And can we actually extrapolate this growth momentum into second half as well? Thank you. Thanks.
Well, so let me first explain the first question. So think of our unit economics. Fourth quarter last year, our new loans, it came with lower take rate and then margin because we reduced borrowing costs. But funding costs, CGI premium, and borrower sourcing costs, they didn't drop at the same pace immediately. And fourth quarter new loans, it took about 25% of 2020 year-end loan balance. So that's why we had lower take rate in fourth quarter last year. And also versus 2019, we had more trust fund and self-guarantee portion. Those are other reasons. But if you look at January 2021, last month's number, as Greg said, in January this year, we delivered record high new loan sales, almost close to 100 billion new loan sales in 1 month. And then we are able to see that the funding cost, CGI premium and borrower sourcing costs obviously drops. And take rate as a result, take rate and margin are very much in line with our previous expectation. So in overall, respect to 2020 overall take rate and net margin levels. And we believe this will continue. And we are very confident for full year 2021, our take rate and net margin for RCF new business really sustain without much change. And the thing of APR, the Supreme Court they clarified 4 times of APR does not apply. It does not apply to financial lending institutions, including banking companies and consumer finance and smaller companies. However, we believe the general guidance from CBIRC remain unchanged at 24%. So we don't have any plan to adjust up our price. And then depending on the progress of funding cost, credit cost reduction, and the operating cost optimization, we further want to reduce our borrowing costs gradually, slowly, to be more price affordable and competitive in this retail credit market, while we can maintain current take rate and net margin levels. So we don't have any immediate plan to decrease price at this moment, but going forward in the long term, we still plan to gradually decrease our borrowing cost. So that's the answer for the first question. And second question is, our sales volume growth. As I just mentioned, we already have proof. January this year, we delivered almost close to 100 billion new sales, which is very strong sales momentum. And going forward, we believe sales growth, the market demand is plenty. And then our sales growth productivity increase is very obvious. For example, last year, without any increase of sales force headcount, we delivered 14.4% annual sales volume growth. So we focus on more and more productivity improvement at the same time with AI applications such as AI video loan that we try to attempt and develop new inbound channels going forward. But in the meantime, because in this China credit market, our experience is, for now, we do not see any other online channels which can give us as good quality borrowers as offline channels such as our direct sales or life insurance agents with high ticket size and then with borrower acquisition cost less than 3%. So in the meantime, our offline driven sales, this will continue with about 85% contribution ratio. But going forward, we are trying to develop further self-acquisition channels.
Got it. That's very clear. Thank you.
Your next question comes from the line of Mei Yan from UBS. Your line is open.
Thank you. Morning. Thanks for giving me this opportunity to ask questions, and congratulations on a very steady quarter again. Okay, my question, the first one is related to regulation. If I can ask Jidong, ask it in Chinese. 季总，我们看到就说，监管呢前一阵子也发过一个关于征信的，一个就是人民银行有一个征信业务管理办法征求意见稿，也有人讨论说这个呢就驻贷的机构今后呢就属于这个征信的范畴，要拿征信牌照，还有业务上呢要符合很多的收紧或者管理。不知道您这个对这一块怎么看？是不是咱们也是有可能会落到这个征信业务的范畴，就是做驻贷的话？ So this question is related to PBOC's earlier draft consultation paper on credit rating business. And some people interpret this may apply to loan facilitation business and loan facilitation and the companies will be required to have a credit rating licensing. Is there something relevant to Lufax? Okay, and then second question, still on the take rate. As I understand that the take rate may be temporarily down in the fourth quarter. Net take rate, net pre-tax profit take rate 3.1% and revenue take rate 9.1%. That's below the previous expectation. And so this year you said it's going to be gradually recover to the range of 3.5 to 4% on the net take rate. What will be the path for that? And what is the recent CGI cost that you mentioned will be 6.7% in fourth quarter, and also on the funding partners cost. And our loan size, the new loans are all below 24% interest rate. Are they the size much larger than before? I remember in the third quarter you mentioned about 200,000 per loan. Is it even higher than that as of now? And any guidance from the CBRC to increase the 20% credit risk exposure to be higher, maybe to 30% or so? Thank you.
这个我先这个有关征信业务这个事情呢，因为征信业务事情现在是刚出台，而且呢，整个这个我觉得到目前为止，它的整个指引还不够详细。那么对这个征信机构、征信业务的它的转业条件以及机构的资质规定，到目前为止，我认为人民银行出台东西还是比较模糊的。我觉得可能目前的情况中，我觉得可能它主要是针对个别的头部的企业，或者我们说白就是可能是埋着整个整改中的一些业务的一些相关规定。那么这些规定最终我觉得在特定的案例上之后实行之后一定会把它推广开来的。那么目前我们认为我们的助贷业务说是直接涉入了征信业务，我觉得这个可能目前还不是个没有明确的一个说法。但是我想说的就是我们一直在跟监管部门有个非常流畅的沟通。如果说将来把我们也纳入这个监管的范围，我相信我们是有整个这个一个应对预案的。目前呢，因为整个情况还不是很不清晰，我觉得可能需要点时间，把监管部门能把他们要求说得更清楚，这样我才觉得市场主体才可以对号入座。
So in terms of the credit scoring business, we think the guidelines at the moment are reasonably early and preliminary. Business requirements and the shareholder requirements of credit scoring institutions, the rules from PBOC are not that clear as of yet. We do think it's probably targeted at leading institutions, specifically probably Ant as part of the ratification plan. This is why this came out. Of course, new rules applying to a special case could be later on widely applied to the industry. In terms of loan facilitation business, we don't think it's currently directly involved. We don't think our business will be classified as a credit scoring institution at this stage. We are maintaining very close dialogues with the regulators. So in the future, if it does become the case, rest assured we'll get enough pre-warning so we can plan and position our business accordingly and early. In conclusion, we think it's early and preliminary stage. We need more clear requirements from the PBOC before we can react to it.
我估计这个信息可能会在上半年的时候会比较明确出来的，我估计需要可能要1个季度的时间，我觉得至少。
So it may take another quarter for the rules to be cleared.
谢谢。
Actually, I think there are 3 more questions. So that question is again about fourth quarter take rate 9.1%, and I explained that's mainly because the fourth quarter new loans came with lower take rate and the margin had to reduce high borrowing costs to less than 24% from September last year. But if you see January number, I believe first number James and David they may share with you in their presentation. January our take rate and net margin already recovered back to our expected level. In overall, it's not less than overall 2020 level already. So we are very good shape by now. And how we reach it to that point? There's an obvious driver funding cost and the CGI premium. CGI premium, our interest partners they also changed charging method from the amount based, loan amount based to balance based from mid-January. So that as a result reduced the CGI premium ratio. And we also decreased our borrower sourcing cost. In January, aside from January, we reduced our sales commission by 15%. So as a result, we saved lots of the borrower acquisition cost. So then that our take rate and margin recovered very nicely at that original level. And the next question, ticket size. Ticket size, we don't see much change in recent few months. Before September 4th, our average ticket size was, if you remember, it was 160,000 RMB. And then since we reduced high borrowing costs and then switched to better quality segment from September 5th with low price, that increased ticket size from 160,000 RMB to 200,000 RMB. So this is ticket size increased by about a little more than 20%. And this is the reason why we could reduce sales commission by 15%. And lastly, about our sales guarantee portion 20%. As of December last year, for new loans, our sales guarantee portion increased to 13.6%. And then we also make it up to 20% in June for new loans as part of discussion with our regulator. But further than 20%, we don't have any plan at this moment. But what I can say is, if regulator requests more than 20%, for example 30%, for that we have enough organic capital to support that the extra more self-guarantee portion. So we don't have much concern.
Your next question comes from the line of Winnie Yu from Bank of America. Your line is open.
Thank you very much for giving me this opportunity. Two questions, I guess. First, regarding, again, the regulation and our licenses. Since November last year, CBRC published the consultation paper for those online microloan companies license. Have you started to communicate with the regulator regarding application for a national operating license? And is there any feedback from regulator on the outlook of, when we will get clarity, certainty on getting this like national operation license? And also, Lufax obtained the consumer finance license earlier last year. So what's the progress in using the consumer finance license? How much of the business, whether it's the loans facilitated or the outstanding balance, is being done via this consumer finance license, and what's the plan there? So that's the first regarding those licenses. And second, James mentioned the accounting difference from booking loans online versus offline. I think by end of last year, roughly, on balance sheet versus off balance sheet. As of end of last year, you have over 20% of the total loans outstanding on balance sheet. So what's the plan there? Do you see that further increase to 30-40%, or is that going to stabilize at around 20% level? So meaning, the related question is when we will see the normalization or stabilization of the account booking for those like revenue and expenses. When will this base effect be normalized? Thank you.
Okay. Thanks for the question. The first question about two licenses, online microloan licenses. We have three licenses in Chongqing, Hunan, and Shenzhen. And out of three, two are nationwide online microlending licenses. But we haven't got clarity and confirmation from regulator about the next level of development of those businesses. Those licenses are not in use at this moment. And then TF license, we got it in April last year. We started business from May last year. And then as of December last year, we booked 6.5 billion new loans with about a little more than 200,000 new customers. And the ending balance was about 3.5 billion RMB. So we made a very good start. And then this is very much different from our pool business. This is a complementary business to serve younger and consumption borrowers. So we believe this is an opportunity for us, and that this can be a new business line going forward. And the focus about accounting method, that James already take up. Online on balance sheet versus offline balance sheet. It depends on our funding mix. And then it's already stabilized, I think. But going forward, our funding mix will be stable with 70% from partner banks and then 30% from trust. And I believe the mix will continue without much change. So as a result, on balance sheet and off balance sheet, this mix, I think it's already got stabilized.
Sorry, just to clarify, how about you taking more? So this 70-30 between banks and trust is already stabilized. Is there any plan, like for example, growing of the consumer finance business might mean that you will have more loans funded by yourself? Is that going to change the picture?
Yes, that's correct. That's very correct. But if you think about our overall scale, our pool loan balance as of today is almost 600 billion. But consumer finance business is how much? It's only 3.5 billion. So no matter how quickly it grows, it doesn't take much portion out of our total loan balance scale. So it will take some time.
So I think we can say with the stabilization in funding between banks and trust in terms of other on-balance sheet will basically be driven by where we take the credit risk. And that is why I said our target would be to 20% by June. So it'll be a little bit more over time, but it's roughly stable.
Because we already at 5%.
Right. And so for the consumer finance license, it will be more contained to do a pretty differentiated business line, which is sort of the unsecured consumer loan. What's the average ticket size there, and what's the lending rate? Is it significantly different from our traditional business?
Yes, that is very much different from our traditional business. The open license, the business score, the ticket size cannot be more than 200,000, but actually it's controlled at less than 50,000. And our ticket size, even for those CF borrowers, is less than 20,000 RMB per borrower. And the average price less than 17% APR.
Thank you. And how about the maturity? Are those like similar to the loans of Ant Bank, which is only like a few months of maturity?
Maturity is quite open. This is line of credit products. It's like a virtual credit card. So customer can choose whenever they spend and then select 8 months repayment. They can select 3 months, 6 months, and 12 months, and 24 months.
I see. Thank you very much.